Good morning, everybody. Thanks very much for joining us in another of the series of GARBE Investment Briefings that we've been running. And this one's focused on the Czech Republic, Poland and Slovakia, what we're calling here the CE3. And we're going to focus particularly on residential and logistics real estate and the outlook for that. So it's going to start in terms of the live stream here with a series of presentations just to get some insight on the latest research in the market. We're going to start with Mark Robinson, who's an economist and investment consultant, looking at the kind of broader view. Then Martin Polak, who's MD for Central and Eastern Europe for GARBE Industrial Real Estate, is going to take a look at some of those other elements of the real estate markets. And then also Ben Maudling, who's Managing Director for Central and Eastern Europe for GARBE Institutional Capital, to pick up on other areas like the residential side and on what's happening in terms of capital and those kinds of things. So it's going to be a fascinating insight. For those who don't know me, my name's Richard Betts, and we run around 60 or 70 of these events, some of them online, some of them in person, as well as at the key fairs like Expo Real. But let's start first of all with you, Mark, if we can. Just share with us the sort of latest research, I guess, that you've got on, particularly on the CE3. Over to you, Mark.
Well, good morning, everybody, and thank you to GARBE for the opportunity of speaking to you all today. As Richard mentioned, the subject of my presentation is really to introduce the CE3 in terms of where we are in the present economic cycle, but also where we are going in the very, very long term in the region. As Richard mentioned, when I talk about CE3, we are referring to Poland, the Czech Republic, and Slovakia. The backdrop to this presentation is really that we are in a decade of high inflation. And I wanted to just start off by just pointing out that in this period, this is not necessarily a bad thing for the real estate sector. It's felt very uncomfortable over the last year or two, in particular, as interest rates have risen in the region, but also obviously globally. But we have to bear in mind, as I've written on this chart, this quite simple equation here, that we are talking about nominal growth. When we talk about nominal growth, we include inflation. So nominal growth equals real GDP growth plus inflation rates. That's the simple equation in economics as to what nominal growth is. And in the real estate world, what that actually translates into is nominal growth equaling rental growth plus capital gain. So those things equate to each other. And I just want you to bear in mind as I describe what's happening in CE3 and as the other speakers describe their sectors, that we are actually including rents in consideration of future potential returns. And therefore, we do have a hedge against what at the moment is a period of quite high inflation, both in the region and globally. But first of all, I just want to show you the very, very long-term story for the region. Some of you will be very familiar with this, some of you less familiar with this. That what we are talking about is a 50-year process of what I call convergence, which is the faster economic growth of the CE3 countries and the other countries within Central and Eastern Europe. But the fast economic growth that we have observed over the last 25-30 years, and you can see on the left-hand side of the chart, I've written the annual growth rates of Poland, Czech Republic, and Slovakia. Very impressive nominal, including inflation, growth rates over those past 2.5 decades historically. And if we continue to extrapolate those growth rates, then we are likely to see a catch-up. And you can see where we are now. I've written here with the bold text towards the right-hand side of the chart with the arrows pointing to where we are now, that the three countries are below the EU average, but in the case of Czech Republic, not substantially below the EU average. What happens if we grow our economies faster than the EU? So if we make an assumption of EU growth at around 2.5% per annum, not in nominal terms, the grey line, If we grow the Czech Republic at 5% nominal, so double the rate of the EU, the Czech Republic actually converges fully with the EU in terms of GDP per capita per person in 2036. Now, Slovakia and Poland are at lower levels now, and they take longer to converge to the EU average, but they get there. So they will have converged by around 2050. So it's this faster differential economic growth that investors into the region and within the region are investing in. They've been doing this for the last 25, 30 years, and they will continue to be able to benefit from this over the next 25 or 30 years. So that's the long-term economic backdrop. That's the reason to consider investing in this region. Now, just to give a little bit of detail on the economies, what we have is economies that predominantly export. So the grey bars on this top chart are exports to GDP. In the Czech Republic, in Poland and Slovakia, we're talking about well above 50% of GDP, 70, 80%, in the Slovakia's case, nearly 100% of GDP is the value of exports. So huge amount of exports, particularly going westwards to Europe, including to Germany. I've got the German figures for reference on the right-hand side. Germany's exports to GDP are high on a global basis, around 50%, but CE3 countries, very, very high. Very significant driver of these economies is exports. And then we've got consumption and investment. I'll make less comment about those. They're less varied from other countries, but they are there. Particularly in Poland, you have to bear in mind we've got nearly 40 million people in Poland, so consumption to GDP of around 60% is quite a big number. Poland is quite a large consumer economy. Slovakia and Czech Republic, obviously smaller populations, more export oriented. Now, what's the composition? What's the composition of those exports? On the bottom of this chart, we've got here the major sectors, and we are talking about electric goods, electric machinery. We're talking about non-electric machinery goods, the two biggest sectors in Slovakia, in Czech Republic and in Poland. But it's the auto sector, particularly in Slovakia, that makes up a huge portion of exports from that economy. If we add up these three sectors, these three major sectors, we are talking about more than around a third of Polish exports, but even more of Czech exports and obviously more of Slovak exports. These three sectors do dominate the export scene. And as mentioned when I was describing the bars above, the grey bars above, exports to GDP are very important. So this gives you a very quick snapshot as to what these economies are and what is driving them. They are export powerhouses, low labor costs, export powerhouses pushing exports into Western Europe. Over the last few years, as we continue to grow the economies, we have seen a lot more investment into higher end exports, and these economies are now competitive on an EU level, even on a global level in some industries. So we are talking here about very well located countries that are very well integrated into the European economy. Now, just to talk about the more immediate macroeconomic situation. Now, obviously, what's been on people's minds front and center over the last couple of years is inflation and interest rates. And what we have on this slide, what I've shown you here, is in the black lines are inflation rates, the red lines are interest rates, and the blue lines are the 10-year local government bond yields in each of these three countries. I'm not going to go into much detail with each of the three countries, because you can see the pattern is very similar in each, and that we peaked out with the black lines between 15 and 20% across the board 12 months ago on a year-on-year basis. So the inflation rates in these countries were amongst the highest in the EU. We have very low unemployment in these economies, so we have significant wage pressure, and we also obviously had energy dependency historically on Russia, which then has, as with the rest of Europe, we had significant energy cost increases in 2022. So we have had a huge spike in inflation. Now that spike is starting to fall. It's starting to abate. You can see the rates of inflation are falling. In Czech Republic, we're now talking about 8.5%. Slovakia's last reading was 9.7%, and Poland is still sitting at 10.1% inflation. Now, the central banks have had to react. The central banks did start reacting in CE3 before the ECB, before the US Fed, and started raising interest rates. They could see an inflation problem last year. The Czechs started in May 2022 raising interest rates almost ahead of every other European central bank. But more recently, what's happened in the last week is that Poland has actually cut interest rates. So Poland cut interest rates from 6.75, if you look at the chart on the top right hand side, to 6%, 75 basis point cut. This surprised the market, and in fact, what's happened is the Polish zloty has actually depreciated by over 4% against the euro as of today, just since last Thursday. So quite a significant move. In my opinion, they are moving too early. It's a positive. It's obviously a decent sign for the economy that they think they're able to cut interest rates, but the market's reaction is telling us that they are moving a little bit too early. We still have inflation of 10% in Poland. This is an issue for the marketplace right now, and it's live. This is an actual live issue. The blue lines on this chart, as I mentioned, are government 10-year bond yields. The reason to think about them in terms of the residential market is obviously residential mortgages. When thinking about purchasing versus renting, residential mortgages are based off these 10-year bond yields. So as the central banks have raised interest rates over the last year and a half, we have seen a commensurate rise in 10-year bond yields, and therefore effective risk-free rates of investing in the residential sector locally. So that's a reference point for the residential sector in the region. Now, the big question is, for the next few years, do we get inflation under control? As I've already mentioned, unemployment is very low in this region, and therefore wage growth is a significant issue. Polish wage growth is still above 10% year on year. Czech Republic's wage growth for the second quarter was reported last week at around 8%, just below 8% year on year still. So we do have significant wage growth in these economies. I'm not going to go through this graphic in a great amount of detail right now, but one factor that is affecting markets right now is the rise in oil prices. The oil price in dollars has risen by 25% since the end of June. So you can see the balloons here, the energy cost balloon and the commodities question mark balloon. Are we going to see a revival in inflation over the next few months, because we are dealing with higher petrol prices, higher imported oil prices? Particularly if you're now in Poland, you're paying 4% more than last week, simply due to the currency going down by 4% against the US dollar. So we do have inflation pressures in the system still. These balloons are suggesting that in 2024 there are quite a few factors still to think about in terms of inflationary pressures. Some of these factors are global, some of them a bit more localized to Central and Eastern Europe, but they are still there. Inflation is not dead. So thinking back to the previous slide and where those black lines go, and whether inflation comes back under control and whether we can see interest rate cuts next year in a substantial manner, we have got a number of factors which are still affecting the inflationary picture on the upside. On the downside, there's other factors. Now, principally, the fact that we have had interest rate rises, so the second balloon along, the fact that we've had interest rate rises means that we are starting to see the effect of these interest rate rises in the region slightly ahead of Europe and America, because the central bank started to raise interest rates earlier. So this is a benefit. This is helping the fight against inflation. So that's good news. But other things are a little bit more uncertain. The impact of the war is very uncertain. The war in Ukraine, the Russian invasion of Ukraine, is still very much a question mark on where inflation goes in the short to medium term. Also, the movement of the currencies themselves. The balloon on the right of the second row. Are we going to see further weakness in the Polish zloty? If we keep seeing weakness in the Polish zloty, inflation in Poland will be higher than the central bank predicts. and that can feed through into Polish inflation in 2024, which affects the interest rate picture then. So there's a lot of uncertainty in the inflation world at this point. And my view is that given there's lots of balloons still indicating higher inflation, and there's balloons indicating lower inflation, we're in a bit more of a balanced picture, but we are not out of the woods in terms of controlling inflation. And there's a debate out there amongst economists, but it is the case that we can still be in this 1970s type of situation of high inflation, high and volatile inflation in Central and Eastern Europe and elsewhere, high and volatile inflation, which then affects your asset, the returns you can get from different asset classes. Now, just to talk about the war in Ukraine briefly, given the proximity of the war, both in time and space, obviously the invasion by Russia was a huge shock, not least the shock in terms of the refugee influx into Central and Eastern Europe and obviously Western Europe as well. But we are dealing with, in the Czech Republic and Poland, between 3 and 4% of the population being Ukrainian at this point still, a substantial amount also in Slovakia, over 100,000 Ukrainians in Slovakia as well. So the balls on the left-hand side talking about the refugee picture. We also have the fact that previously we had a lot of male Ukrainians working in these economies, helping to alleviate the labor force pressures that we had and low unemployment rates, and therefore the Ukrainians could find easy work, particularly in the construction sector. A lot of them obviously went home to fight the war against Russia. That's affected the labor picture to a certain extent. Also, we've had higher costs, higher food costs, higher commodity costs as an effect of the war has affected the overall situation, affected wage growth in Central and Eastern Europe at this point. And then there's other effects of the war as well. A positive one on the right-hand side there is nearshoring, that companies that were maybe thinking about investing in Russia or Ukraine are investing more in Central and Eastern Europe. This is also a post-COVID effect where we're getting nearshoring from other continents as well, from Asia, and then we have some other the other effects as well from the war situation, the significant more fiscal support from the EU is certainly another positive, that the EU has stepped up in terms of helping the CE3 countries through the refugee crisis. So a lot of financial support has come into the Central and Eastern European region, but the main effects have been on the demographic situation in the region and also on inflation as an effect of the Russia-Ukraine war. So in terms of a shorter-term prognosis, where are we going? Where we've come from in 2022 on real GDP growth. This is real GDP growth, not the nominal GDP growth I was describing before. So this is excluding inflation. We are talking about moving from quite high rates of growth in Poland, over 5%, and Czech and Slovak between 2 and 3%, to a recession or near recession in Poland and Czech Republic in the first half of 2023. I believe that we are likely to see these economies trough out in 2023, bottom out. So the GDP growth then recovers into 2024 and 2025. Now, this occurs because interest rates are being cut, and therefore some domestic demand comes back into play. Consumers see the lower interest rates and they start spending again. And also, particularly moving into 2025, a recovery in the Eurozone, stronger growth in the Eurozone for similar reasons that the Eurozone inflation and interest rates are all, the picture there is also easing by 2025. But the recovery is a little bit slower than you might expect, given the strength of these economies' historical real GDP growth. What we do have is still quite high inflation. So remember, these figures, you add inflation on to get nominal growth. So the inflation at the moment is drowning real GDP growth a little bit, as consumers have to try to absorb those higher inflation rates. And finally, just wanted to sort of reflect on the effect of all of this on the real estate sector. The investment scene in the region is a little bit stagnant at this point. The blue bars on this chart are yields. They're actually Collier's yields for the end of the first half of 2023 for the prime assets in the office, industrial, and residential arenas in the major CE3 cities. On the left-hand side, I've got the 10-year bond yield for the Eurozone sitting around 3.4%, and also the overall all-in funds rate, which again provided by Colliers at 5.75%. The point is here that these yields are not significantly higher. They're in euro terms. They're not. Sorry, the industrial and office yields are in euro terms. The residential yields are sometimes quoted in local currency terms, but the all-in funding is that level. That red bar there is higher than these yields. So that as investment opportunities, it's difficult to get leverage at this point that makes sense to invest. So what we've seen is very, very low transaction volumes in these commercial real estate markets over the last year or so, as the effect of higher interest rates is absorbed. But remembering what I described at the beginning about nominal growth equals capital growth plus rents, the rental picture is a little bit more healthy. We have, if we look at recent historical figures, that over the last 12 months, we've seen quite substantial growth in industrial rents in the capital cities in CE3, particularly in Prague and Bratislava. And this is also, if you go outside of Prague and Bratislava, it's also the case in these countries. In terms of official OECD statistics, on the right-hand side of the bars in blue on the right-hand chart are the rental growth nationally in these three economies. Now, again, you can go to different geographical pockets, and Ben might mention this, that have actually seen much higher growth than those nationwide figures. But the fact is, we do have rental growth support. So we are getting some protection from inflation in these sectors. And this is important then thinking about the yield and whether capital values can stay steady and cope with higher inflation in the short term. It does look like we've got enough rental growth to be able to do that. So without further ado, I'll pass back to Richard, and hopefully Martin and Ben can describe this in a bit more detail. Thanks.
Great, really interesting, Mark, and that longer term perspective, particularly the sort of conversion, towards the EU norm, for example, is really interesting to give that perspective over sort of 25, 30 years, I think is great. Lots to unpick there, and we'll certainly pick up that in the discussion. But let's come over to you now, Martin, just to give some of your perspectives there and the latest research that you're seeing.
We have over 55 years of the company history. And we, besides logistics and industrial real estate, we also operate as a residential developer, a commercial real estate developer, but also we invest in science and tech, or for example, data centers or photovoltaic infrastructure. We are a company from Hamburg, where also our headquarters for industrial real estate is located, and we have currently around 13 billion assets under management with over 750 employees. I think approximately slightly less than half of employees is currently in industrial real estate field. Poland is currently heading to 30 million square meters of industrial space. It's the largest market in CE. I think it's also therefore the most attractive for institutional investors. It has been proven over the time that demand in Poland from occupiers and from tenants is usually at a very high level. It's very stable. I think the tenants learned that doing business in Poland is very easy. It's searching for the space or for the big box space is very often much easier than in the other countries. Poland also is positioning very well, not only for investors as tenants, who are of course also investing into their premises, investing into their business in the country, but also for other investors in our sector. Poland proved to be very reliable. I think very well you can predict environment there. You have a lot of evidence, comparables. Simply, if you look at last 10 to 15 years, there has been enough going on to search for enough data and to make a decision based on the numbers and based on what we experienced already on the market. I think historically, Poland, due to the strong supply and equally strong take-up, they didn't manage to grow rents so much, but there is a strong evidence in last couple of years. I think we come back to that on the other slide. And currently, the continuing strong demand and more complicated environment with the interest rates and with bank financing and liquidity that further supports the rent growth. And it seems, as in many other markets, that the rent growth is able to offset the movement of the yield, and the demand is sufficient for the main market players to continue business as normal, obviously being a little bit more cautious, maybe having sometimes some struggles with the liquidity, but definitely we cannot see that the market would stop or the market would be too negatively influenced at the moment. You can see currently where the prime yield is. I think Poland has been seeing quite good compression. I think we will see on Czech Republic slide something very similar. And currently we are somewhere at 6%. I would say I think we a little bit struggle to show, or the valuers a little bit struggle to show 6% yet, but we see more 6+ deals happening on the market, which are sometimes core plus or value add deals, but still there is not enough probably core acquisitions to support yield below 5%, below 6%, but clearly somewhere there in that ratio, and it basically shows to be back somewhere in 2018, 2019, and maybe that also indicates that we should not expect some further growth of the yield, and probably we are somewhere stepping on one place for some time currently, and I believe that will be proven over maybe next 2-3 quarters. What is interesting is also that you can see the peak capital values currently. It's interesting, comparable maybe to Czech Republic later on. That is obviously driven by the rent growth and yield, of course, but still, if you look at it from pan-European perspective, you are buying still warehouses in Poland rather cheap if you compare to Western European market or even to Czech Republic. Quickly, where the demand is coming from in Czech Republic, still good destination for nearshoring, very easy destination for German manufacturers, producers, e-commerce companies. We see very active north-west border with Germany, also south. Currently, I think the Czech Republic is benefiting from what's going on in the world, from a little bit of geopolitical uncertainty. Many German companies don't want to grow in China, don't want to go too far east. This is also a little bit tricky now for Poland that people are worried about the border with Ukraine, and we see that people are more focused on the western part of Poland. Here, Czech Republic obviously doesn't have any borders too far east. It's very close for Western European management. It's very often easy flight to get in there, or driving distance for German companies. So we see still some kind of another wave of companies who are seeking for cheaper labor, seeking for more labor, meaning that in Germany currently we have very big problem to hire 450 people in one place. It's still possible in Czech Republic, despite of all the challenges we have with labor as well ourselves. What is interesting against Poland is, or incomparable with Poland, is still that prime yield is still quite low, somewhere at 4.5%. I would say in reality the deals are happening somewhere between 5 and 5.5%. It's quite well known that Czech Republic doesn't offer enough products to be sold on the market, so sometimes we are struggling with evidence. And compared to Poland, where we see a lot of trader developers and a lot of developers and operators who sell assets right after the completion, there is almost nobody who does the same business model in Czech Republic, because around 85% of the market stock belongs to long-term holders and developers who build for themselves. Currently, the Czech market is going to, I think, it's going to exceed 11 million square meters. There is, we believe, still strong potential, but comparing to Poland, for example, Czech Republic has very difficult permitting process. It's more land constrained, which is obviously also geographical thing, and it is also driving the liquidity higher, rent higher, and it, I think, from the long-term perspective, offers investors higher upside potential. You can here see capital values, for example, from 2020 to 2024. If you recall Polish slide, it has been somewhere around 12 to 1400. Here we are somewhere between 2000 and 2500. So basically, in Czech Republic, you already can have a feeling that you are buying, you are paying basically Western European capital values. On another hand, I think here it's important to go a little bit deeper into the market, gain more experience, and understand really what is behind it, and why there is still solid rent growth story, and why the product is so liquid. You can see also on the prime yield side that we are going somewhere at 5+% territory, but we also see that 5.2% is actually quite realistic expectation, and might stay, this area might stay with us for a couple of quarters, I believe. I believe there will be some assets traded in coming months or quarters which will support somewhere for 525 area, and due to lack of product on the Czech market, it actually never hit 4% or never get below 4%, but definitely there was a potential if the Ukraine war didn't start. So we basically didn't experience exactly what was happening in Germany when the yields were much lower, but we also don't see such a big shift back up at the moment. And I think when you can see what was happening between 2015 and 20, maybe something similar and maybe with the smaller steps will be happening in next 5 years as well. We will see. What is also important here is that investment volumes, although it's every other year higher or lower, Czech Republic is known for having a lot of domestic capital available for logistics, and a lot of Czech funds are very active in logistics, and that is probably the biggest difference against Poland, where I think only 3 or 4% of the Polish capital is being invested in industrial real estate. And that is again probably connected with the fact that Poland is very good institutional market. For big institutions, it's very easy to understand and to collect the data, as any other big market. Basically, if you look at Germany, UK, France, these are all big markets where people can easily operate because you have enough data and you can trade the assets. In markets like Czech Republic, I think you need to be a little bit deeper in the market and understand some of the local consequences. And I think, and because of the lack of product, you need to be ready to source the opportunity, or you need to be good enough and deep enough on the market to source the opportunity and ready to go for it if such an opportunity occurs. And that makes Czech market more suitable for Czech capital, and probably the Polish market more suitable for international capital. It's obviously the smallest market from these 3 where we operate. It's also the size of the market is basically something what is always being a disadvantage for Slovakia. Most of the operators, developers, investors operate Slovakia together with Czech market, which is very logical. Due to Slovak geography, most of the market is in Western European, in Western Slovakia, which is again location very well connected to Czech, to Budapest, to Vienna. Basically, Bratislava is very good place for Central European distribution, Pan-European distribution. One truck drive of 8 hours can reach a very big part of the wealthiest European regions. So based on that, this market has been established and created. It's never been market driven by the domestic demand, but more by international companies. And any asset you look into in Slovakia will be full of international tenants who operate internationally and operate at least cross-country or Central European distributions and so on. The yield currently is somewhere around 6%, which is not driven by any evidence at the moment, but it's driven by the fact that Poland is there, and there is basically no rationale to buy for 6% Slovakia rather than 6% Poland. We would rather see Slovakia to be perceived as another Czech submarket, and to be perceived as liquid, or more liquid as we can see in Czech Republic, but that comparison with Poland is absolutely fair, and for investors it makes sense that Czech Republic is the most expensive, Poland is second, and Slovakia is right after, and the liquidity is the same. Slovakia, Czech is basically the most liquid market. Poland, I believe as well, but as I said earlier, in Poland you most likely sell assets to institutional investor, and therefore you just need to compile with the numbers and with the data. We also see quite tiny investment volumes, but it's good for the given size, and it's also seen on the prime yield slide, where we also didn't compress as much and we also don't have then such a shift back upwards. We will see what's next, but I think Slovak yield will be pretty much behind Czech and Poland, really depending who will be, for example, unable to source opportunities in Czech market and Polish, and who will trade what kind of assets in Slovakia, because also there is not so much to trade for core buyer. The rent growth here probably similar to Poland, not so fast and not so strong as in Czech Republic, but I think quite fair. And we see that these rent levels are absolutely fine for the occupiers. And in terms of demand at the moment, as I said earlier, a lot of automotive probably, which is the difference from other submarkets, but mostly international companies.
Thanks very much, Martin. Interesting to get that. I think that the differences there between those three markets, and also what you're seeing there in terms of the yields, but also what's driving rental growth. We're now going to come to last but very much not least, Ben, over to you, and look a little bit at the residential ones, and we'll make sure that there's time for questions afterwards. But Ben, over to you.
Thanks, Richard. Good morning, everybody. This morning, I'm going to look at the outlook for the BTR market in the Czech Republic and Poland. GARBE focuses, for its shareholders and investors, GARBE focuses on sectors where we can deliver strong income streams and good long-term returns. In addition to logistics, one of our key sectors is BTR logistics. It's a BTR residential, sorry. 2 years ago, we established a fund for pan-European residential, and that has currently about 200 million euros worth of BTR assets. For this webinar, I'm focusing on Czech Republic and Poland. That's nothing against the other CE countries. It's just that we're not active yet in Slovakia and Hungary and Romania. They share many of the same characteristics as Czech Republic and Poland, so it's likely we will be there in the future. I'm focusing on the BTR market. That means, it's also known as multifamily. That means new build or new refurbished, good quality, professionally managed properties have high levels of ESG compliance and are specifically being designed for rental purposes. It's a small part of the wider PRS market. To give you an idea, in the UK, BTR makes about 1.7% of the wider PRS market. In Germany, about 1.1%. In Czech Republic and Poland, it's far below 1%. So that's where the opportunity is. In my opinion, along with logistics, BTR is the hottest sector in Central Europe for real estate. We forecast strong growth, both in terms of occupier demand and investor interest. So our forecasts are based on our own research, but also on the data coming out of the respective research houses. So with that bold statement, let's dive in. In terms of the main value drivers for the BTR market in Czech Republic and Poland, we see economic outperformance, which Mark touched on, the growth of the rental sector generally, a supply and demand imbalance, strong rental growth and capital growth projections, and increasing activity of institutions in the residential market. Mark, in his presentation, showed that the GDP growth in Czech Republic and Poland and the other Central European countries since 1986 has been almost double what in terms of percentage per annum of the other Western European countries. And we're seeing here on this slide that the forecast for the next 5 years is also strong. Mark indicated that as well. As we come out of the current situation, we expect to see strong growth of the GDP going forward. Mark also touched on the fact that the Czech, Slovak and Polish economies are moving in on parity with Western Europe in terms of GDP per capita. For someone who's lived in the region for a long time, that's quite exciting and quite remarkable. So look forward to being part of that. In terms of that prosperity, of course, there's increasing wealth amongst the population, particularly the young population. And the young population in Czech Republic and Poland is no different from the same generation in other parts of the world, meaning that they see renting accommodation, residential accommodation, as much more viable than previous generations. We also see ultra low unemployment. I think it's about 0.8% in Warsaw and 2.2% in Czech Republic, in Warsaw, I say in Prague, sorry, which is obviously in turn fueling the BTR industry. The affordability. Certainly we're seeing premium rents being achieved for standing BTR property in Warsaw and Prague at the moment. Generally, over the last 10 years or so, we've seen a big growth of the overall PRS sector. To give you an idea, in Germany, the sector has grown 24% years between 2011 and 2021. In the same period, it's 20% in the UK. And you can see from the graphs on the left there that the growth of the BTR sector or multifamily sector within the PRS sector has been even more pronounced. Now, what we've got in the Czech Republic and Poland are conditions that mean that the growth of the BTR sector could be even stronger going forward. The graph on the right shows the current percentage or level of rental stock amongst the total stock of accommodation. You can see that Poland and the Czech Republic are much lower than the EU average. We expect that to change over the next 10 to 15 years. Also, it has been noted that within that current rental stock, there's a very high level of obsolescence. A lot of the current rental stock dates from the Soviet times. Into that in the future. Also, we've got a situation, particularly in the Czech Republic, where there's a severe lack of affordability in terms of buying. I think the Czech Republic is at the top of the list of the least affordable place for people to buy their own apartment. And also, we've seen in the last year, both in Czech Republic and Poland, a tightening of the rules, meaning it's hard to qualify for the creditworthiness level to get a mortgage, so it makes it even more difficult. We're also seeing, I think, governments becoming more and more reliant on the private sector to provide the rental stock that's required. Czech and Polish governments are focusing very much on prioritizing defense, energy security, healthcare, etc., not on state social programs or housing programs. We also have in the region a high level of shared services businesses. These employ a large amount of young professional, local and foreign employees who are obviously a target audience for BTR. And then lastly, we have low levels of urbanization relatively to the rest of Europe. In Poland and Czech Republic, it currently stands at about 63%, whereas the EU average is at 74%. So we expect there to be increasing levels of urbanization in these countries, which also means there's going to be a drive on BTR products. The BTR market in Czech Republic and in Poland is very much at early stages. To give you an idea, in Prague there are about 5,000 units, or in Czech Republic it's about 5,000 units in 45 buildings. There's about another 5,000 in the pipeline. In Poland, it's being forecast at the end of this year there will be about 19,000 BTR units, with forecasts of 30,000 by the end of 2025 and 42,000 by the end of 2027. It's hard to forecast where it will go, how much stock will be needed going forward. There have been forecasts that in the next 10 to 15 years, in Poland, we'll see the need for 400,000 rental units. That's over a 10-fold increase. That might sound a bit fanciful, but when you see factors at play and what's happening in other Western European countries, maybe it's not so crazy. For this, I'm focusing on Poland just because it's more advanced in terms of BTR than the Czech Republic. There's more data available. In some ways, the Czech Republic is a more attractive market, given that there's arguably higher salaries. But as Martin mentioned, we have a very tough permitting situation which restricts supply. So just for this slide, I'm looking at Poland. It's been estimated in the total housing stock, not just rental, there's an undersupply of about 1.5 million homes in Poland. That's a current stock of about 15 million. And 500,000 of those units acquired are in the main 6 cities. This undersupply is not just in terms of the numbers, but also in the quality, as I touched on earlier. So you see there, on the right-hand side, Poland in particular performing very badly in terms of number of dwellings per 1,000 inhabitants, the overcrowding rate, and the average number of rooms per person. So definitely a need for new good quality stock. In terms of demand, you'll see, before it's gone to demand, the supplies on the left, you see the map there, relatively small numbers of existing and pipeline BTR products in properties in the main cities. In terms of demand, as Mark touched on, large number of Ukrainians in the Czech Republic and Poland, which added pressure on an already undersupplied market. And hence, we've seen strong rental growth in the last year in both Czech Republic and Poland, and BTR of over 20%, which is obviously leads to questions about affordability, but we'll come on to that later. In terms of rental and capital growth projections, so we've made our own projections based using data from main research houses and also looking at the forecast for the bond market. As Mark's touched on, we've got obviously inflation in play as well here. But what we're seeing is that we expect there to be very healthy rental growth next 5 years for BTR properties, so 24–25% over the next 5 years, and that leads to a similar level of capital growth. We're not using in those figures. We're not using drastic cap rate compression either. So you can see Warsaw and Prague performing very well compared to many other cities in Europe in terms of those projections. Yeah, here we see this is for investment volume across Europe. And we've seen in the last 8 years or so, the allocation to residential from the investors going from 10% up to a forecast of 19% this year. In the same time, office allocation going down quite considerably. Jones Lang have actually just put out data showing that for the first half of this year, the living sector accounted for 28% of all investment, which is equivalent to office. So you can see residential is growing in its allocation. This reflects the changing needs of society, obviously, an increasing importance of residential. It also reflects the increasing liquidity of the sector and the requirement for wider portfolio diversification. I think once we have the satisfactory BTR product in Czech Republic and Poland, there is no reason why investors will not be investing quite considerably in those countries in that stock. They've already investing in the other sectors in those countries. To give you an idea, at the end of 2020, 50 billion euros of assets in residential assets transacted across Europe. This year, the first half this year, it's 14.8 billion. Half of that was in Germany and UK. Actually, we expect investment volumes generally to be going up in the future years. Like most sectors, the BTR sector has had headwinds in the last few years due to the factors that Mark touched on. We've had high inflation, high interest rates, lack of investor capital. But we're seeing the outlook improving. One of the factors that euro-denominated investors have investing into the BTR market in Czech Republic and Poland is hedging, and we're seeing those costs now. The forecasts the next 10 years coming down. So in April 2021, we saw the 10-year hedging cost at about 0.84% for the Czech crown. Now it's forecast at 1.13%, significant decrease, going at a high at 3.43% in January 2022, the escalation of the Ukraine war. We're also seeing, on the positive note, we're seeing obviously inflation coming down, as Mark touched on. We're also seeing construction costs coming down, like in some countries in Eastern Europe. So I think that concludes my quick presentation. I hope it was useful, and I hope I showed that there's considerable potential in the BTR sector in Czech Republic and Poland, and most likely in other Central European countries. Thank you.
Yeah, no, that's great, Ben. I think it's really interesting to see that change in terms of the allocation side with living and obviously BTR, then residential being significantly higher. There's a limited time left, but I just wanted to pick up on some of the questions that we've had. And if you look at the chat on the right-hand side of your screen, do please add any questions there, and I'll deal with those just in the last 5 minutes. But that's been an incredibly detailed, I think, overview on what's happening in the market, where we're seeing some of the opportunities, and particularly, obviously, the industrial and residential side, where there's a great deal of investor appetite generally, across Europe. We've had a question come in from Christoph, which is the significance of ESG aspects in CE compared to Western Europe. And I know there's a big focus there, but does somebody want to pick up that in terms of the significance of ESG? Obviously, a big focus in Western Europe about assets being stranded, transition risk, those kinds of things. Does anybody want to pick that up for the CE region?
I'm happy to do that. In terms of residential, very, very, very important. So touched on that a lot of the existing stock is not up to anywhere near the required standards, particularly with the hike in utility costs. There's a big demand from tenants for energy efficient accommodation, and the banks that are financing BTR projects. Hugely important.
Okay, good. And Martin, we've seen quite a lot of focus on, solar. There's going to be an increasing focus as well on electrification, I guess, in terms of power grids and those kinds of things for the industrial logistics side, especially. Is there any difference in terms of the focus between CE and Western Europe? Do you think in terms of the ESG side, or do you think it's just that the market really has to move in lockstep together, Western Europe and Central and Eastern Europe?
I think what Western Europe does better is that most of the countries who really believe or really put also this electrification as their priority, they are ready to jump into the deep water and then deal with the issues with the grid, for example, and so on. I think our mentality is sometimes like we try to make our grid perfect before we connect another capacity which it doesn't have at the moment. We see issues sometimes in Germany and Netherlands with the grid and with grid providers not being able to connect new projects or to handle current consumption. But on another hand, in Central Europe, we see other problem that grid companies are too careful in connecting not only new photovoltaic installations, but also new consumptions. So we try to make our grid perfect before we move on, and Western Europe is moving on and then dealing with the issues with the grid, I would say. And it doesn't mean that Central Europe would have less focus on ESG, because ESG is not only about electricity, but it probably just shows sort of a culture difference between us, and that is maybe more down to Czech, Slovakia, Hungary, less for Poland. I think Poland is more opportunistic and will be more Western European in this respect. And I think they showed with their infrastructure, highway infrastructure, that they can get it done. They can make big improvements in good time. But it's not the case of Czech Republic, for example, or Slovakia. I think that's where we're gonna be behind, and I think we will have to have some kind of lesson learned to realize that.
Great, really interesting, I think, to pick up on. Thanks very much for that question as well there, Christoph. We're right up against the end of our time, but that was a huge amount of analysis there on the markets to be able to pick up on. Great deal of opportunity as well was what was coming through from my side, and that when we see that and we're looking at the markets, there's still that divergence play, that there's a great deal of focus on that residential side and industrial logistics. And interesting to see as well from you, Mark, I think some of those impacts of the war, which are less spoken about in a way, which I think is very interesting to see. There is a great deal of information in here, and we will make the slides available to you so that you'll be able to access those and look at them. Thanks very much for joining us here online and for your questions as well. That's been really useful. Thank you very much to the speakers. Really interesting content. So all I wanted to say is look forward to seeing you at the next event. Thanks very much, everyone, for joining us. And if you're joining us on demand, thanks very much for watching. Thank you, everybody.
Thank you.
Thank you.
Thank you.